So in IFOS, let us continue with next concept. Concept number 6, award. Usually awards are taxable. If tomorrow Raj Classes gives me award, if tomorrow some private institution gives me award, best employee of the year, best teacher of the year, whatever, okay, and with award, if they provide me some money, that money is taxable under IFOS here. But if it is the award by the government in recognition of the service of a soldier, okay, Bharat Ratna award or Padma Bhushan award, obviously those kind of awards should not be taxable. Therefore, it is exempted under section 1017A. Next, family pension. So far as pension is concerned, you need to revise what happens in salary. Pension, obviously it is after retirement benefit. So assessee have been retired. If it is going to be taxed under the head salary, so then it should be received by the employee. Okay, it should be received by the employee. And there are two types of pension in salary head that we have discussed: commuted pension and uncommuted pension. Uncommuted pension means monthly pension. Monthly pension means it's like a salary which is fully taxable for all the employees, government employee, non-government employee, fully taxable. If it is a commuted pension and if it is received by the government employee, then fully exempt. Okay, if it is received by any other employee, then there are two situations: gratuity received, gratuity not received. Okay, gratuity received, gratuity not received. If gratuity received, then it is 1/3 of full pension amount is exempted. If gratuity not received, then 1/2 of full pension amount, 1/2 of full pension amount will be exempted. Something like this we have discussed in salary chapter. Imagine employee have died. Employee have died. Obviously, all this taxability will not arise. Now the family, a widow or legal heir of the employee are receiving pension from the employer on monthly basis. Then it is, please understand, family member after the death of employee. Then because family member are not having employer-employee relationship, no employer-employee relationship. Therefore, a family pension received by the widow of the employee should be taxable under IFOS head. Now it is taxable under IFOS head, but it provides deduction under section 57. Sir, how much is deduction provided? So deduction is provided to the tune of, please understand, to the tune of 15,000 per annum. It's not per month, it's per annum. 15,000 per annum or 1/3 of family pension, whichever is the lower. This is the deduction provided. 15,000 per annum or 1/3 of the family pension, whichever is lower, is the deduction given by the government. So if you receive 40,000, if you receive 30,000, very easy number. If you receive 30,000, then 1/3 of 30,000 is 10,000 or 15,000. So 10,000 will be exempted. And come on, please tell me, 10,000 will be exempted, 1/3 or 15,000 per annum, and 20,000 will become taxable. If you received 60,000, then 1/3 of the 60,000 is 20,000, but 20,000 will not be allowed as a deduction. Maximum deduction is 15,000. So 15,000 will be allowed as a deduction and 45,000 will become taxable. So this is how you need to remember the law. Next. So family pension of armed force members, military, who have died on the duty, obviously it should not be taxable. Therefore, it is exempted under section 10. Next, if you are having a company and there are directors in the company, okay, the directors of the company are running your company. Now there are two types of directors we have in a company. One is executive directors, full-time directors, whole-time directors, managing directors. All these are employee of the organization. Please understand, all these are employee of the organization. Executive directors, full-time director, whole-time directors, whatever these names, they are employee of the organization. And please understand, then there are non-executive directors, independent directors, strategic directors, some name like this you will find. These directors are not employee of the organization. They come only during the board meeting. As per Companies Act, there should be minimum 4 board meetings in the company at an interval of 3 months on an average. So please understand, whenever these people come for attending the board meeting, and for attending the board meeting, if you are giving them some remuneration, that remuneration is not their core income. Therefore, it will be taxable under the head IFOS. I would like to tell you one more thing here. If it is the employee director, his TDS will be deducted. His TDS will be deducted under 192, for employee director, and if he's a non-employee director, professional director, independent director, then TDS will be deducted under 194J at the rate of 10% without any threshold limit. So 194J also you should link here at this point. Okay. Income from mutual fund or UTI. My dear friends, income from mutual fund or UTI earlier it was exempted under section 1035. Now the exemption is deleted. Therefore, income from mutual fund or UTI is fully taxable. And because it is fully taxable, you should also link TDS provision 194N. Before giving income in your hand, TDS will be deducted under 194N. Next chapter, we are going to discuss clubbing of income. If any income earned by a minor child, if any income is earned by the minor child, obviously it was the money created by the father. If a 6-month-old baby is having fixed deposit in the bank, obviously that money was not earned by him. So that fixed deposit was not created by him. So father or mother must have created that income. So if you are having a minor child and that minor is earning the income, minor is earning the income will be clubbed in the hands of the parent, but the parent in whose hand this income is getting merged will get exemption, again, very, very important, 1,500 per annum, 1,500 per annum per child, and there is no limit on children. Okay. Per annum per child. If you are having a 4 children, you will get exemption for all 4. So this is what you need to remember. 1,500 per annum. It's not per month, it's per annum. Okay. And balance will be taxable. So this is what you should remember for minus income. The next income that we must discuss here is the casual income. So casual income means income from lotteries, income from puzzles, income from horse races, income from other games, income from gambling and betting. If you are earning income from any of this way, it is fully taxable under section 115B, under section 115BB. One B is missing here. 115BB. Okay, at the rate of 30%, fully taxable, no exemption, no concession, full rate of tax is 30%. No deduction under 57, no chapter 6A deduction. If out of lottery income, if you put some money in, your chapter 6A, okay, ATC, ATD, you will not get any deduction, my dear friends. Okay, no benefit of basic exemption limit. If you are winning the lottery of only 2 lakh rupees and you are not having any other income, my dear friends, still this 2 lakh rupees will be taxable at the rate of 30%. No concession of basic exemption limit will be given against the lottery income. So if I'm having a betting losses, okay, and there is a betting gain, of 4 lakh rupees, betting losses of 3 lakh rupees. Will I be able to set up this? Answer is no. You cannot set up the losses. You cannot carry forward the losses. Government ignores expenditure. Government ignores losses. Only gain will be taxable in the chapter IFOS. Now, my dear friend, you need to understand one more thing here. For all this, winning from lotteries, crossword puzzle, card game, gambling, for all these 4 sections, there is a TDS provision. TDS provision under section 194B. At the rate of 30%, TDS will be deducted. Okay, 30% is the TDS rate. And if it is horse races, then for horse races, we are having TDS under 194BB deductible at the rate of 30%. So TDS will be deducted at the rate of 30%. You should know this. Sir, in organization, you are having certain keyman insurance. Okay. Keyman insurance policies will be taken by the employer. Employer will pay premium to the insurance company on the behalf of the keyman. So who are the keyman? Keyman are the important personnel for the organization. If tomorrow something happens to this personnel, the organization will suffer huge losses. Therefore, to protect itself, protect the organization, employer will pay premium on behalf of the keyman to the insurance company for the safety of the keyman. If tomorrow something happens to keyman, natural, unnatural, for any reason, keyman is not with us, okay, and the organization have suffered the losses, then insurance company will pay the amount on maturity or amount on the put of the claim. And if the claim is received by the company, so please understand, when the company had paid the premium, they have taken the deduction under PGBP chapter. Receipt of claim will be recovery of the losses that organization have suffered because the keyman is no more with them. So it will be taxable under PGBP. Sometime organization says Keyman stayed with us for all his life. Okay, for 30 years he has worked with us. So we should honor him by transferring the insurance scheme to the Keyman. So what will happen now? It will be taxable in the hands of Keyman as income from salary. Sir, what if Keyman have died and the money is received by any other family member, or the Keyman was not an employee of the organization? Then in that case, it will be taxable as IFOS. So what you must remember here is, while taking the premium, while paying the premium, the organization will get a deduction for sure for premium expenditure. And on maturity, whenever amount is received, that amount is definitely taxable. It will be taxable in the hands of employer in the PGBP chapter. If it is received by the employee of the organization, IFS chapter. If it is received by any other person, it will be taxable under IFOS. So this is what you must understand, my dear friend. Usually life insurance policies maturity is exempted under section 1010D usually, and that we will discuss under ATC. ATC you have to read with section 1010D. Please understand that. Okay. So I guess I should take a halt here.